China's bond market just got a massive lifeline, and it could change everything about how global yields behave this year. The People's Bank of China, in a highly unusual move, announced a second round of outright bond purchases via reverse repos. This is not your standard liquidity maneuver. This is a full-blown attempt to prevent a cascading collapse in China's debt markets. And if you think this only affects China, you're about to be blindsided. Because this bailout doesn't just prop up Chinese banks, it signals a deeper fracture in global debt dynamics, and it could ripple straight into your portfolio. Let's break this down. Beijing's latest bond rescue package is not a standalone stimulus. It's the second coordinated liquidity injection this month, part of what analysts are calling a stealth QE, quantitative easing in everything but name. The central bank is buying up government and policy bank bonds to stabilize prices and suppress rising yields, which have quietly surged across the mainland since April. What triggered this? At its core, China is battling a silent credit crunch. Local governments still buried in post-pandemic debt and real estate fallout are struggling to roll over existing liabilities. Private firms are defaulting at the highest rate in years, and even state-backed developers are teetering. If the bond market were left to correct naturally, yields would spike, asset prices would plunge, and institutional panic would take hold. So the PBOC stepped in. But here's where it gets dangerous, because the mechanism they're using rewires global expectations for yield behavior. Right now, global investors are watching two conflicting trends. In the West, particularly the US and Europe, there's rising chatter of rate cuts. Bond yields are sliding. But in Asia, led by China, central banks are being forced to do the opposite, suppress yields through artificial support because organic growth isn't kicking in. This divergence creates arbitrage. Capital doesn't stay still. If Chinese yields are artificially compressed through central bank buying, but inflation in the West remains sticky and rate cuts stall, global capital could flow towards safer, higher-yielding Western bonds. That drains emerging market liquidity and worsens the credit squeeze in places like China and Southeast Asia. And here's the kicker. It doesn't just affect sovereign debt. It affects corporate bonds, mortgage rates, and even private lending dynamics. A JP Morgan strategist summed it up last week. This is not just a bailout of the Chinese bond market. It's a preemptive strike against a broader Asian liquidity crisis. That's the reality. What the PBOC is doing is essentially front-running a collapse. But in doing so, they may have just triggered the next phase of global bond realignment. Let's zoom out. China holds over $800 billion in U.S. Treasuries. It's been quietly reducing that number over the past 2 years, selling bonds and rotating into gold, commodities, and yuan-denominated assets. If yields in China remain artificially low and the domestic bond market is propped up by central bank buying, that trend accelerates. In other words, China may dump even more treasuries just to maintain internal stability. This could put upside pressure on U.S. yields, especially on the long end. And with America's fiscal deficit ballooning past $2.1 trillion this year, any upward force on borrowing costs could turn dangerous quickly. Here's where the loop tightens. On June 16th, China's central bank conducted a 400 billion yuan 6-month reverse repo operation, following a 1 trillion yuan 3-month liquidity injection earlier in June. This marked one of the largest such operations since the pandemic-era interventions. That same week, U.S. Treasury auctions saw weak foreign demand. Coincidence? Maybe. But when you pair these events with the fact that BRICS nations are accelerating local currency trade and de-dollarization policies, the pressure becomes undeniable. This is a global yield contagion. The yield on China's 10-year government bond fell back to 2.29% this week after rising steadily since April. Meanwhile, U.S. 10-year yields hovered near 4.35%. With signs of upward bias as inflation remains above 3%. The spread is unsustainable without major capital imbalances. And here's the mid-script reset. What happens if this bond bailout fails? Because that's the unspoken fear. Central banks can delay market corrections, but they can't eliminate risk. If confidence collapses, if China's interbank lending market seizes up again, we're looking at a potential Lehman-style freeze, only this time centered in the East. And that's where the global yield structure truly breaks. One stat to hold on to, an estimated 75 to 90% of LGFV debt is used to cover basic operational costs rather than productive infrastructure. These vehicles hold trillions in debt. If credit access dries up, even temporarily, the risk of cascading defaults becomes very real, and no bond buying program will be large enough to contain the fallout. Investors, pension funds, and even sovereign wealth funds will be forced to reprice risk overnight. That repricing could bleed into everything, from municipal bonds in the U.S. to high-yield corporate credit in Europe. This is a hidden web of modern finance. Nothing is truly local anymore. The final emotional turn is this: we are entering a global phase where artificial control of bond markets is becoming the norm. From Japan's yield curve control to the ECB's backdoor purchases to China's stealth QE, central banks are all trying to avoid the same thing: a mass awakening to structural debt unsustainability. But manipulation has limits. If China fails to restore market confidence through this bailout, it may trigger a reassessment of sovereign risk pricing across the board. And in that reassessment, global yields may no longer follow central bank guidance. They'll follow fear. And fear, once unleashed in bond markets, is impossible to contain. Watch the yields. The bond bailout may look like stabilization, but under the surface, it's a sign that something much deeper is cracking. This is your signal. If bond markets are being artificially stabilized at this scale, ask yourself, what truth are they trying to hide? Don't wait for the collapse to understand it. Stay ahead. Stay prepared. The financial system may look intact on the surface, but beneath it, the foundations are starting to shift. If China can't hold the line, everything changes, not just in Beijing, but in every bond market around the world. This is your wake-up call. And there's something else no one is talking about. Chinese banks are being quietly instructed to absorb more government bonds, not by choice, but by directive. This coercive support mechanism might work temporarily, but it hides the real stress under the surface: lack of voluntary demand. When buyers must be forced to hold bonds, the illusion of market confidence collapses. Meanwhile, in the West, they're pausing rate hikes, but inflation's proving stubborn. This contrast between artificial bond stability in China and fragile rate expectations in the West is setting the stage for major dislocations. If global investors lose faith in the PBOC's ability to contain the crisis, capital flight will accelerate. Capital outflows have begun to rise again, with investor confidence wavering as bond volatility picks up. While precise numbers remain fluid, several major funds have trimmed their China exposure in recent weeks, and the trend is growing. Here's what that means for you. Every major global portfolio, whether sovereign wealth, hedge fund, or pension, relies on some version of the yield curve to manage risk. If that curve starts behaving irrationally, if artificial suppression becomes the new norm, price discovery dies. And when price discovery dies, volatility takes its place. We're not just witnessing a bond bailout. We're witnessing the beginning of a global repricing of risk. China may be the first domino, but it won't be the last. Stay sharp. Track the signals. And remember, in today's manipulated markets, what breaks first is usually what was propped up the longest. Subscribe to Wealth Signal if you want the truth before it hits the headlines.